All Friday, the 10th of November, and there's a few things out in the news today that are of interest. I don't know if you guys have been paying attention to this lawsuit that was filed against the National Association of Realtors with respect to how commissions are paid. Pretty big damn deal, right? It started off where a couple of large national real estate companies settled on this, which other real estate companies are like, why would they do that? They're setting a precedence. But they probably smelled some stuff in the air because that lawsuit yielded $1.8 billion. Basically, they awarded $1.8 billion to the plaintiffs. Crazy, right? So it's changing the landscape of real estate as we had know it up to this point. Dig into that and go into Fortune. Fortune's got, you can look up their website, read about this thing that happened. It's going to change real estate. So you as a real estate investor, though, I don't know how the real estate investor is going to change as much, because when you're dealing directly with the sellers, like what we're doing for the most part, doing the turnkey stuff, your BRRRR stuff, that kind of stuff, I don't know it's going to affect it as much. Definitely going to affect the people who are working with realtors. So your home buyers buying houses to live in, people going directly to the market, the MLS. MLS has had big influence over how things get done. MLS has had massive influence. In fact, when an appraiser goes out there and appraises a house, there's requirements from the appraisal requirements out there, the stuff that they have to operate under, and those regulations says that they have to use so many comps from the MLS. Why? Because National Association of Realtors, one of the biggest lobbyists on the damn planet, bigger than oil, bigger than pharmaceutical. That's why that's still in there. I don't know how it's going to affect it, but it might be something where this is just, I'm guessing that appraisers might be able just to use some of those what is right now considered off-market comps. It's not off market. You put it on the market, somebody buys it, that's what it is. But they believe if you're not putting it on the MLS, it wasn't marketed in the area properly. Mm-hmm. That to me is a bunch of political bullshit that they sent people in there to lobby to be sure that the MLS stayed viable. Now, I'm not trying to bust up the realtors out there whatsoever. There's a necessity there. People need to be that, but also you need to be professionals, guys. If you're out there, the type just listed on the MLS and wait to get paid, that's why that lawsuit hit. That's what I see when I'm thinking about it. But if you're out there hustling, working your ass off, making sure this is a profession, you're professional about it, I think you'll be safe. That's personally how I see this kind of thing. Also, a lot of back and forth talk with respect to the Fed. What's going on with the economy? Do we raise rates? Do we pause? Are more raises coming in the future? How is the economy doing? Looks like jobs might be a little bit better than they really were, guys. It's not as great as they're trying to make. They're playing the market out there. They're not literally attacking it the way that they should. And especially since we know that's been said that they just really don't understand inflation as well as they think. There's not a lot of history, or at least a lot of experience within the Fed on the governor level that doesn't come out of education or within the Fed itself. Not as much of being on the boots on the ground, seeing the effects of decisions and how it affects individuals. Now let's just get down to it. When we start talking about people with decision-making capability, especially in DC area, on more of a global area, how many of those people have actually been in the economy to know how a decision affects the average individual in the US or the average individual globally? They don't. They have been so insulated from that for so damn long, they're making decisions based upon theoretical bullshit in reality. So they're going on speculation and theory, and in reality, now continuing to fuel the philosophies that they're benefiting the few and not the many. This could be what's going on here. Why we have things happening the way they do in the Fed, I can't say for certain. But what I can say is any belief that our interest rates are going to get better, a lot better, still going to be, I believe is going to be off. Let's take a look at what I see in the charts here and see what has happened over this last week or so. So I've had people call me up and say, oh, the news said we had the biggest drop in interest rates and it's such and such length of time, so we should have better interest rates, they said, in the last year or so. So we should have better interest rates than we were a year ago. It's wrong in the sense that rates are better than they were back at that point. They have just dropped or got better from their worst point in the last month or so. So if we look right here, this channel that we've been following, I've been following this channel all the way back. I built this a long time back. I've been talking about it for a very, very long time. We broke out of this channel back here, October 2nd. We stayed out of the channel, tried to get back out of it, bounced right back out of it. I drew a different channel, went below it, thinking maybe we're now forming a new channel. And because of all the negativity in the market, or at least the fake positive news on the economy. We're pushing bond buyers out of it, therefore bringing the value of it lower, therefore having the cost of these loans rates going up. As this goes down, rates go up. And then we had more realistic news with respect to the jobs. All this had to do with the economy, making it look better than it really was when it really wasn't. Now, more realistic. It wasn't actually, I'm sure there's a lot still being padded here, but more realistic information on the jobs came right back into the channel. What's interesting here is even though we've had this massive movement to the better, it's not a ton better, guys. It's not huge. It's still huge on charts here, but it's not moving the needle on the interest rates a bunch. We're still in the high eights. But look at this. Where are we at compared to when we left the channel? We're dead even with when we left that channel. Rates didn't go down a ton in the last year. They're still higher than they were back when we left that channel in October. Now, we locked a lot of people back here that this swap, there's some things that we're doing with in bulk loans for some of our real estate investment partners who are selling houses, a bunch of them with one interest rate, buying a bunch of money. If you want to know more about that, contact me. But right here, we locked a bunch of those back there. We're still lower in the bonds than we were back then, higher in the interest rate. So the rates haven't even gotten better than they were back at that point in September. So just understand the rates are still trending upwards as this is continuing to erode downwards. We're still in this channel. We're going to maintain this channel from what I understand for some time. We'll probably keep going out here. It's possible we hit double digits. We should actually be close to double digits right now when you look at mortgage-backed securities and where they are. They should be pushing us closer to double-digit interest rates. But the thing is that we are not at that point because we're charging points. Points are being charged on every deal. So that way, you're not going to be tempted to refinance when the rates or if the rates go down. So that's the other thing you got to consider. Some people are saying, well, why am I still paying points? I had this conversation today with somebody. Why am I still paying points for an interest rate? Well, let's take a look here at what the average interest rate is for a person buying a house to live in. This is bankrate.com, 7.83. We did get some significant improvement from that 8.09. So we did see this improvement, 0.25%, right? So as you can see, 0.25% was not significant with all that movement. So when they're saying we had the biggest drop in interest rates in over a year, it's 0.25%, guys. Not huge. So I don't think we're going to get this massive movement. So I had this question today saying, hey, how come we can't just get a 0-point rate? You'd be close to 10%, probably about 7.5, 7.6, 7.7, maybe, who knows? Because think about this. The people who are in there making decisions in the capital market side of things, in many spots, they may not be in this industry more than 10, 12 years, or at least in the position we're at right now to make decisions. Their belief is like, you look back in history, at least for the most of their career, interest rates were in the single digits, in the 5s, 4s, that kind of thing. So they're thinking rates could come back down because that's what they know. They know that environment. They don't know the real environment of interest rates are above this. Average interest rate from 1971 to 2009 was 9.1% for the average homeowner, over 10% for an investor. They don't know those kind of rates. So since they don't know that, they can't compute that interest rates are actually in a normal level right now. The thing, if they go down and they are giving you, say, a 9.5% rate today at 0 points, you'd be tempted to refi if it's an 8.5 interest rate later at 0 points. So if it goes down to that point and it happens in, say, 1 to 2 years and you refinance, they lose a ton of money. Why do they lose money? Because it costs a significant amount of capital for them to take that loan that's closed, get it audited, secured, and set up for servicing. And if you refinance any time in that first 3 to 4 years, they lose money. So the philosophy that I understand, I could be wrong, is we offer the rate that we think it could go down to at 0 points, but do that at charging points today, so that way people aren't tempted to refinance. That's why we are where we are. If you have any questions about that, want to know more about that in greater detail, call me. You can just text me, 602-291-3357, 602-291-3357. I'll send that text on to Bree. She'll set us up for a call. Always here to help you. Want to give you the best information you can to make sure you're successful. And remember, guys, interest rates, they're on their way. They're on their way up. And it's going to go into consolidate. It's going to have less people come to play in the game that you already know how to be successful, which is not about the interest rate. It's about the deal itself. If you need more information about the deal, text me. We'll talk about it.